Silicon Valley Bank, America's 16th largest bank, failed after depositors hurried to withdraw their money as anxiety over the bank's situation spread. Its collapse is the largest since Washington Mutual's demise in 2008, a watershed moment that triggered a major financial crisis and crippled the world's markets since. SVB could no longer cope with the massive withdrawals of its customers, and its last attempts to raise new money did not succeed. Following this, U.S. authorities officially took possession of the bank and entrusted its management to the U.S. agency responsible for guaranteeing deposits, the Federal Deposit Insurance Corporation, or the FDIC. In today's video, we will discuss why SVB failed, who was affected most, and how it may or may not affect the wider banking system in the U.S. and worldwide. Before we get started, don't forget to hit that subscribe button, like and share the video as it's the best way to help us grow as a channel. Founded in 1983, Silicon Valley Bank specialized in banking for tech startups. Companies such as Airbnb, Cisco, Fitbit, Pinterest, and Block Incorporated have been clients of the bank. In addition to financing venture-backed companies, SVB was well known as a source of private banking, personal credit lines, and mortgages to tech entrepreneurs. By the end of 2022, SVB had become one of the largest banks in the U.S. by asset size. It had $209 billion in assets and about $175.4 billion in deposits. SVB was obviously the beacon of the startup venture community for 4 decades, and it was one of those institutions that everyone viewed as too big and too strong to fail. But the bank was hit hard by the downturn in technology stocks over the past year, as well as the Federal Reserve's aggressive plan to increase interest rates to combat inflation. The bank bought billions of dollars worth of bonds using customers' deposits as a bank would normally operate. These investments are typically safe, but the value of those investments fell because they paid lower interest rates than what a comparable bond would pay if issued in today's higher interest rate environment. Usually, that's not an issue because banks hold onto those for a long time, unless they have to sell them in an emergency. But Silicon Valley's customers were largely startups and other tech-centric companies that started becoming needier for cash over the past year. Venture capital funding was drying up. Companies were not able to get additional rounds of funding for unprofitable businesses and therefore had to tap their existing funds, often deposited with Silicon Valley Bank, which sat in the center of the tech startup universe. So, Silicon Valley customers started withdrawing their deposits. At first, that wasn't a huge issue, but the withdrawals started requiring the bank to start selling its own assets to meet customer withdrawal requests. Because Silicon Valley customers were largely businesses and the wealthy, they likely were more fearful of a bank failure since their deposits were over $250,000. That required selling typically safe bonds at a loss, and those losses added up to the point that Silicon Valley Bank became bankrupt. The bank tried to raise additional capital through outside investors but was unable to find them. Bank regulators had no other choice but to seize SVB's assets to protect deposits still remaining at the bank. On Friday the 10th of March, outside the bank's Santa Clara headquarters in California, a few nervous customers wondered how they could access their funds, some trying to guess what was going on through the closed glass doors. Soon after SVB was placed under the control of the FDIC, a notice was put up guaranteeing customers of their deposits up to $250,000. According to estimates, many companies and individuals stood to lose more than half of deposits in excess of that. Some high-tech companies were hit hard by the news of SVB's failure. Streaming device maker Roku said they had around $487 million, or 26% of its cash reserves, deposited at SVB. Roku shares have gone down 10% in extended trading, but the company said that it continues to believe that its existing cash equivalence balance, and cash flow from operations will be sufficient for the next 12 months and beyond. But smaller companies spent the following day in heightened panic, as some of the startups depending on SVB became concerned over their ability to pay their employees post-shutdown. On the markets, the panic movement started the previous day, after SVB announced that it was seeking to raise capital quickly to cope with the massive withdrawals of its customers without succeeding, and having sold for $21 billion of financial securities, losing $1.8 billion in the process. The announcement surprised investors and rekindled fears about the soundness of the entire banking sector, especially with the rapid rise in interest rates, which is lowering the value of bonds in their portfolios and increasing the cost of credit. The four largest U.S. banks lost $52 billion on the stock market on the 9th of March, and in their wake, Asian and European banks floundered. The SVB Group has offices in European countries such as in Ireland, Denmark, and Sweden, but its international arm is thought to represent a minor part of its overall business, with just 3% of its total client funds coming from abroad. Yet, SVB's fall and its ripple effects outside the US were clearly felt. In Paris, Société Générale lost 4.49%, BNP Paribas 3.82%, and Crédit Agricole 2.48%. Elsewhere in Europe, the German Deutsche Bank dropped 7.35%, the British bank Barclays 4.09%, and the Swiss UBS 4.53%. On Wall Street, the big banks recovered Friday after the rout of the previous day. JP Morgan Chase took 2.54%, while Bank of America and Citigroup lost less than 1%. Mid-sized banks, or ones more focused on one type of customer on the other hand, faced greater in turmoil, with First Republic dropping nearly 15% and Signature Bank dropped 23%. At the moment, experts don't expect there to be any issues spreading to the broader banking sector. There might be some pockets of instability caused by this, as seen in the dip the crypto market took on Saturday morning, but it already showed signs of recovery later in the day. Silicon Valley Bank was large, but had a unique existence by servicing nearly exclusively the technology world and VC-backed companies. It did a lot of work with the particular part of the economy that was hit hard in the past year. Other banks are far more diversified across multiple industries, customer bases, and geographies. Due to its exclusive nature, SVB's fall is less likely to cause a major financial crisis. According to financial analysts, the problems encountered by the bank are very specific and are not likely to affect the entire banking sector, let alone the major banks. Additionally, U.S. and international regulators have introduced more stringent rules since the last financial crisis, aimed at ensuring that one bank's failure would not trigger a cascade event, harming the broader economic system. But there might be economic ripple effects, especially in the U.S. tech startup world, if the money currently remaining at Silicon Valley Bank can't be released quickly. To stem the potential contagion from SVB's collapse, U.S. financial regulators rolled out emergency measures. At the time of making this video, the FDIC has guaranteed that depositors with SVB will soon have access to all their money. President Biden is yet to speak on this issue and address how the U.S. can continue to maintain a resilient banking system. Until then, leave your thoughts on SVB's collapse in the comments below. Thanks for watching and see you in the next video.